What if I told you that the most successful investors in history share a trait that has nothing to do with intelligence? It has nothing to do with studying complicated charts, nothing to do with following the Federal Reserve, and nothing to do with waking up early to check the Asian markets. In fact, this specific trait is something that most people in our hyperproductive society would consider a flaw. It is something we are usually ashamed of. There is a famous story in the financial world about a study conducted by Fidelity, one of the largest and most respected asset managers on the planet. They wanted to answer a simple question, but the answer they found was anything but simple. They wanted to determine which of their millions of clients achieved the absolute highest returns over a long period of time. They looked at the data, expecting to find the professional traders, the hedge fund managers, or perhaps the hyper-disciplined individuals who check their portfolios every single morning to make smart, calculated adjustments. But that is not what they found. When they crunched the numbers, the highest performing accounts actually belonged to two specific groups of people. The first group consisted of people who had completely forgotten they even had an account. And the second group? They were people who had passed away. Let that sink in for a moment. The investors who did absolutely nothing because they were either forgetful or literally dead outperformed the smart, active, educated, and stressed out investors who were trying to beat the market every single day. This sounds like a joke. It sounds like a paradox that should not exist. But it is actually the most profound lesson in building wealth that you will ever learn. It reveals a glitch in the matrix of how we perceive success. It proves that in the game of money, effort does not equal reward. In fact, in the stock market, effort often destroys reward.
Welcome to Mindset for Wealth, where money meets mindset.
Most of us are taught from a very young age that if we want to be rich, we must work harder than everyone else. We are taught to hustle, to grind, to pay attention, to be proactive. But the data suggests that in investing, this is the wrong approach. The lazy investor wins because they do not make mistakes. They do not sell when they are scared. They do not buy when they are greedy. They simply let the system work. So this begs the question, how do you replicate the performance of a dead investor without actually dying? How do you achieve that level of perfect detachment while you are still alive to enjoy the money? You need a cheat code. You need a system that removes your human flaws from the equation entirely. You need to build a machine. Welcome to Mindset for Wealth. In this video, I'm going to show you exactly how to automate your wealth building. I will show you how to set up a financial machine that builds your fortune while you sleep, so you never have to worry about the stock market again. This is the guide for the lazy genius. To understand why the inactive investor wins, we must first look at why the active investor loses. The problem is not the economy. The problem is not the inflation rate. The problem is biology. For hundreds of thousands of years, human beings survived by reacting quickly to threats in our environment. If you saw a predator in the bushes, you ran. If you saw an opportunity for food, you chased it immediately. This instinct is what kept us alive in the wild. It is hardwired into our DNA. But in the financial markets, this exact same instinct is what keeps us poor. When the stock market crashes, your survival brain screams at you to run away. It pumps cortisol, the stress hormone, into your system. It tells you to sell everything to stop the pain of seeing your red portfolio. When the market is booming and everyone is making easy money on the latest hype stock, your survival brain screams at you to chase it. It pumps dopamine into your system. It tells you to buy before you miss out on the feast. This creates a disastrous cycle where you are constantly buying high because of greed and selling low because of fear. You are doing the exact opposite of what you are supposed to do, not because you are not smart, but because you are human. Psychologists call this the action bias. We as humans have a deep need to feel like we are in control of our destiny. We feel that doing something, even if it is the wrong thing, is better than doing nothing at all. We tinker, we adjust, we check our apps 10 times a day just to see if the number changed. But every time you touch your portfolio, you introduce risk. You introduce the possibility of making a behavioral mistake. You also introduce friction. Every trade you make might trigger a tax event. Every trade might have a small fee or a spread. Even small costs compounded over 20 or 30 years can eat away a massive portion of your wealth. There is a famous study by Dalbar that measures the difference between what the market returns and what the average investor actually keeps. The gap is massive. The market might return 10%, but the average investor might only get 4 or 5%. Where did the rest of the money go? It was lost to bad timing, panic selling, and chasing trends. The investors in the Fidelity study who had forgotten their accounts did not have this problem. When the market crashed in 2008, they did not sell. Why? Because they did not know it was happening, or they did not have the password to log in. They rode out the storm simply by being absent. And because they held on, they captured the entire recovery that followed. They succeeded because they removed the single greatest risk to their financial future: themselves. So if we know that our own brains are liabilities, how do we protect our money from our emotions? We cannot simply decide to be more disciplined. That is a trap. Willpower is a battery that runs out. You might be disciplined today, but eventually you will have a bad day at work, or you will get scared by a news headline and you will make a mistake. The answer is not to fight your nature. The answer is to build a system that bypasses your nature entirely. You need a mechanism that acts logically, even when you want to act emotionally. This brings us to the core strategy. This is the cheat code that the wealthy use to ensure they stay wealthy, regardless of what the economy is doing. It is called total automation. Most people budget backwards. They get paid, they pay their bills, they buy groceries, they go out for dinner, they buy clothes, and then if there is anything left over at the end of the month, they try to save it. But there is rarely anything left over. There is a law called Parkinson's Law, which states that work expands to fill the time available. In finance, we can adapt this to say that expenses always expand to fill the income available. If you see the money in your checking account, you will subconsciously find a reason to spend it. You will upgrade your lifestyle just enough to burn through that extra cash. To win, you must reverse this flow completely. You must pay yourself first. But you cannot rely on your memory or your discipline to do it. You need to set up a chain reaction that happens the moment your paycheck hits your account. Here is the step-by-step blueprint for the machine. Step 1 is the automatic transfer. You must log into your bank account and set up a recurring transfer for the day after you get paid. This money should move instantly from your checking account to your investment account. It should leave your hands before you even have the chance to think about spending it. This utilizes a psychological trick called out of sight, out of mind. If the money is gone before you wake up, you will naturally adjust your spending to whatever remains. You will not feel deprived because you never really had the money in your hands to begin with. You are essentially hiding money from your future self. Step 2 is the automatic purchase. This is the step that most people miss. Moving cash to a brokerage account is not enough. You must invest it. Cash that sits idle is being eaten by inflation. Most modern brokerage platforms now allow you to set up automatic investing. You tell the system to take that cash and buy a low-cost index fund or a diverse portfolio immediately. This strategy utilizes a powerful mathematical concept called dollar cost averaging. It sounds technical, but it is actually very simple. And it is the secret weapon of the lazy investor. Dollar cost averaging means you buy the same dollar amount of an investment at regular intervals, no matter what the price is. You do not care if the market is up, down, or sideways. You just buy. Let me explain why this is mathematically superior to trying to time the market. When the market is high and expensive, your fixed amount of money buys fewer shares. This is good because you are buying less when the price is bad. But when the market crashes and everyone else is panicking, your fixed amount of money buys more shares. You are automatically scooping up more value when stocks are on sale. This completely eliminates the need to predict the future. You do not need to know if we are going into a recession. If we do, great. Your machine will buy more shares at a discount. If the market goes up, great. The shares you already own are worth more. It is a win-win scenario. This turns your investing into a mandatory bill. Just like you pay for electricity or internet to keep your life running today, you pay this bill to keep your life running in the future. Once this system is live, you are free. Now that you have built the machine, you must understand why it works so well over the long term. It works because it unlocks the true power of compound interest. You have heard that compound interest is the eighth wonder of the world. Einstein supposedly said that he who understands it earns it, and he who does not pays it. But most people forget that compound interest has a weakness. It is fragile. It only works if it is left uninterrupted. Imagine planting a seed for a giant oak tree. If you dig it up every week to check if the roots are growing, the tree will die. It needs to be left alone in the dark soil. Automation forces you to leave the money alone so the roots can grow deep. Let us look at two imaginary investors to illustrate this point. Let us call them Busy Bob and Lazy Larry. Busy Bob is obsessed with the market. He reads financial news every morning. He watches every YouTube video about the next coming crash. He subscribes to newsletters that promise to tell him the next big stock. When the market drops 10%, Bob gets nervous. He thinks he is being smart, so he pauses his contributions. He says he is waiting for the dust to settle. He moves to cash. Then the market suddenly rebounds. Bob misses the jump. He waits for a dip to get back in, but the dip never comes. He ends up buying back in at a higher price than he sold. He is working very hard. He is stressed. He is losing sleep. And because he pauses and restarts constantly, he kills his compounding. Lazy Larry is different. Larry set up his automatic transfer 5 years ago, and then he went fishing. He does not know what the S&P 500 did today. He does not know what the inflation report said yesterday. He does not care. When the market crashes, Larry's machine just keeps buying cheaper shares. He does not stop it because he is out on the lake fishing. When the market rallies, his machine rides the wave up. He never interrupts the process. Over 20 or 30 years, Lazy Larry will almost certainly end up wealthier than Busy Bob. But more importantly, Larry is richer in time. This is the part that nobody talks about. While Bob spent thousands of hours worrying, analyzing, and stressing over red and green candles on a screen, Larry spent that time living his life. He spent that time building his career, playing with his children, traveling, or sleeping. This is the ultimate return on investment. Automation does not just buy you money. It buys you mental freedom. It buys you the ability to sleep at night knowing that your financial future is being taken care of, whether you get out of bed or not. There is a concept called becoming a time billionaire. A financial billionaire has $1 billion, but they might be old and have no time left. A time billionaire is someone who has complete control over their time. Automation is the bridge to becoming a time billionaire. If you are constantly managing your money owns you. You are an employee of your portfolio, but if you automate your money, you become the owner. The money works for you. So what is the catch? Why doesn't everyone do this? The catch is that it is boring. It is incredibly boring. There are no dopamine hits. There are no exciting stories to tell your friends at a dinner party about how you timed the top of the market. You cannot brag about a boring index fund that you bought automatically. We are addicted to excitement. We are addicted to the idea that complex problems require complex solutions. We think that because the financial world is huge and scary, the solution must be difficult. But the truth is, the solution is simple. It is just hard to accept that simple works. You have to be willing to be boring. You have to be willing to surrender the illusion of control. You have to trust the math more than you trust your gut feeling. This strategy requires a shift in identity. You have to stop viewing yourself as a trader or a market timer and start viewing yourself as an asset accumulator. Your only job is to accumulate assets over time and let the world economy do the heavy lifting for you. Let us recap the cheat code. First, accept that you are the biggest risk to your wealth. Your biology is wired to fail in the stock market. Second, decide to remove your willpower from the equation. Do not rely on discipline. Rely on a system. Third, set up the automatic transfer from your checking to your investment account to happen the day after payday. Fourth, set up the automatic investment to buy a diversified index fund immediately. Fifth, and most importantly, forget the password. Go live your life. There is a quote that says, "The stock market is a device for transferring money from the impatient to the patient." Automation makes you artificially patient. It forces you to be the person who receives the money, not the person who gives it away. Do not let the simplicity of this fool you. This is how real wealth is built. It is built quietly, it is built slowly, and it is built automatically. If you want to win the game of money, you must stop playing it every single day. The goal is not to be the smartest person in the room. The goal is to be the most consistent. And the only way to be perfectly consistent is to hand the job over to a machine that has no feelings. Do not be afraid of a boring investment strategy. Boring is good. Boring is profitable. When your money is boring, your life can be exciting. You can focus on your health, your relationships, and your passions, knowing that the heavy lifting is being done in the background. If you want to build true, lasting wealth, stop trying to beat the market and start automating your success. Thank you for watching Mindset for Wealth. If you found value in this calm approach to finance, please subscribe to the channel. We are building a community of investors who think in decades, not days. We believe in strategy over hype and peace of mind over panic. I will see you in the next video.